Hey guys, welcome to this week's Money and Investing Show. This week we are talking about red flags and green flags in the world's biggest economy. That is the US, of course. Lots of economic data coming out. Making sense of it, of course, becomes a little bit more challenging. Let's listen to our take on this. Hopefully we can give you a few key pointers to keep you safe, on the straight and narrow, most importantly, profitable. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Laurential.
Thank you for having me on the show, Mr. Baxter. I'm not sure if it's that suit being in blue, but it makes you look awfully tanned.
Sun-kissed, I believe.
Sun-kissed.
Month in the Mediterranean will do it for you every time.
Very jealous, very jealous. I'll get there one day. Speaking of which, let's talk about somewhere else across shore, and that's the US. Major headlines coming out of there right now. We've just had the Jackson Hole Symposium Economic Conference. Seems to be a bit of a mix of data at this stage in the US, green flags and red flags. I want to talk about both of those.
Always interesting, isn't it, when you've got that sort of stop-go, accelerator brake, risk on, risk off. And I think more than anything, and I'm sure we'll get to this as we go through the podcast, Mitch, is the fragility of markets, where a comment, albeit from someone substantial and someone whose comments carry weight, but a single comment can have a massive impact on markets. And I think that just shows the sort of fragility that markets are in right now, where they're looking for the cues and clues as to what's happening next.
Indeed. Well, here's a statistic for you. It's actually the shortest speech from a central bank governor ever at a Jackson Hole Symposium, and it had one of the largest effects on markets.
Keep it to the point, say what you mean what you say, and get that message across. And in all fairness to Jerome Powell and the US Federal Reserve, they've been extraordinarily good through this cycle at really communicating with markets. They haven't waffled, they haven't been vague and created inferences. They've been absolutely font 50, bold, underlined, specific about what they're doing. And I think that's really a great way to see markets stewarded through really volatile conditions. We're going to raise interest rates. It's going to happen. It's probably going to be this or that. That's the sort of information that markets thrive on versus, what our Reserve Bank has done here in Australia, which has been really sort of murky and open to misinterpretation, according to Dr. Philip Lowe, not my favorite person, as everyone that follows this podcast would follow. And that's really poor guidance from a central bank. Make it clear, make it obvious, and markets respond to that versus uncertainty and vagueness is not there. So certainly Jerome Powell's comments had a direct and immediate impact on markets. And as I say, that reflects the fragility of where things are at right now. Right, one comment, boom, and you get a 3% move.
Yep.
Or 17% move up in UVXY on Friday.
Nice trade, by the way.
Very good trade.
Now, AB, the whole notion of these decisions or these speeches or comments these central banks are making is in respect to the data, which comes out. So can we get a short rundown on how important data is, what kind of data is important, and what effect it has on markets?
Look, we've been in a situation where markets have really been looking for some solid headlines to anchor into. Obviously, the post-COVID world, war in Ukraine, inflation creeping up, all of those things have weighed very, very heavily. And so, the focus, I think, from investors, if we turn the clock back, just to last year, which was a nice bullish trending market, at least up until November, headline to headline data releases weren't that important. We're in a good trending market, but as we've gone into choppier times, the sets of eyeballs really looking out for and anticipating data has been huge. So let's take CPI, consumer price inflation, and PPI, producer price inflation, as two pretty important headlines, given the fact that the conversation is about inflation, as it has been now for the last 6 months, and what we've started to see is a bit of an easing in those, which is great news. It showed that price pressure is starting to ease off. There's always a lag between PPI and CPI, but they're both starting to show a little bit of weakness there. I think a lot of that is due to the fall in energy and commodity prices. And for those people that study history, particularly history around markets, weaker commodity prices typically are usually a sign of, you're getting towards the back end of a bear market. Usually when you start to see that happen, it's one of the sort of final confirmations that you typically look out for in those circumstances. So not only is it the absolute data, but it's the underlying cause. Lower energy prices, weaker commodity prices have seen PPI come off a little bit and seen a little bit of the easing of pressure, I think, from an inflation perspective, which is good news and may mean that we're more on track for what's called a soft landing rather than a recession, which is good news all around.
Totally. A number of green flags there, and I think it's important for our listeners to understand any piece of data which affects interest rate decisions is what causes the market to move as it has been.
Correct.
Any other good pieces of information that we've had come out in the US, AB specifically?
Well, the earnings season was deemed as being, pretty positive. The companies will get in the confession booth and have to say, how the last quarter has been and what they anticipate going forward. And to a large extent, that surpassed expectations. That said, expectations were so incredibly low that any hint of light at the end of the tunnel was deemed as being largely positive. So by and large, it was a reasonable earnings season, which the market responded well to. We saw a nice move higher, but the underlying challenges facing the economy haven't gone away. If you look at earnings and consumer sentiment, let's tie the two together. I do think that that's still a cause for concern in the US, because whilst inflation may slow down, we've got to understand that inflation is that rate of change in prices. Now, if prices move up very steeply, that's inflation. If in prices stay high, that's not inflation. Okay, and that's a really hard one for people to get their head around. But once prices move up, they very seldom move back with the same level of gusto. And so, that's really hit the consumer. It's hit the consumer in terms of their confidence in the US, insofar as, higher grocery bills, which is a global phenomenon. And as we see, geopolitical events in the Ukraine and China and things like that constrain supply of goods and services. Prices have definitely moved high. Energy prices have moved high. It's starting to come back a little bit now. And that's really affected the consumer and the spare money, the discretionary money they've got left at the end of the day to go spend on what they choose to. And I think that's going to continue to have a more marked effect as prices maybe don't rise as much, but are more durable at those higher price levels, and we've got to contend with a more expensive economy to live in. And I guess what I'm talking about there is something called a trade down, and that's where if you go into the grocery store, maybe you're not buying the brand that you want. You might get a cheaper brand. It's still pasta sauce. It's still X or Y. It's just not necessarily that premium brand that you would normally go for. And that's the sort of thing that does hit earnings over the longer term for companies, for sure. So that's a mixed one to look out for. But I think that does have some level of risk still associated with it. From a retail perspective, the consumer went ballistic last year. Most closets in the US are pretty full of clothing, and so you can sort of see that sort of sector probably will be continuing to run into a bit of a headwind, I think.
Yeah, it's funny you say that. We just had our Aussie retail sales figures out. 0.3% was the expected. It was at 1.3. Yeah. So very healthy on the consumer's part, likely because we're at full employment. So what about employment in the US, particularly, AB?
Yeah, I mean, the employment's still been, and when you talk about employment and unemployment in the US, the measure for unemployment is quite different to here. Obviously you've got to be actively seeking work, et cetera, et cetera. We also saw a lot of people leave the workforce, when COVID happened. And that's not something to be sort of dismissed to the annals of history. We saw the same thing here in Australia, where let's say you're sort of transitioning into potentially retirement and you think, well, it's all over now anyway. May as well just take an early retirement and coast through. A lot of people did that and left the workforce. One of the things that and we've seen this sort of quiet quitting movement, which has also caused some issues within the labour markets, where people that have been under a level of stress, poor them in this work world that we live in. You wonder how they'd handle stress like a depression in the 1920s, for example. But parking that to the side for a moment, people have sort of gone through this quiet quitting movement and now having to come to terms with a manifestly more expensive cost of living, and that's bringing people back into the labour market. Is that, and because we've had full employment, wages have moved up as well, so it becomes more attractive to be in the labour market too. So you're starting to see those people creep back in, which is is a phenomenon that's quite unique to what we've seen in the last sort of 18 months in markets. The employment markets are really, really healthy, which is good to see. What we've seen in Australia, which is maybe slightly different from the US, is, and this also is underpinned, of course, by the welfare system we have here in Australia, that even though we've got full employment and in fact more people, plenty of vacancies, 700,000-800,000 vacancies in the marketplace right now, we've also got more people on benefit than that were there before COVID too, and that sort of nice warm bottle to suck on has prompted probably a bit of tardiness of people getting back into the workforce. That's not such an issue in the US because the welfare support system for unemployed people is virtually non-existent.
All right. Well, there's a lot to digest there, AB. What are some red flags that we're seeing in the US right now?
Look, I think, politics would have to be a huge one. We've got the midterms coming up on the horizon. I don't think that's going to be particularly pleasant for the Democrats. And I'm not saying this with any level of political bias. There's just been a vacuum in terms of leadership. And some of the successes you might talk of would be, the IRA Act, the Inflation Reduction Act, which is legislation that's just been passed to get prices down. It's a really nice political headline.
Sounds good.
It does. And, the intention of it is great. But like anything, when the government try to interfere with things, it usually has the opposite effect. I think you're going to see quite a substantial long-term wait before you see anything remotely directly impacting on inflation pressure, which is the number one pressure for the US economy right now. An example of that is the ability for harder negotiating for the prescription drugs between hospitals and the drug companies, which is it's the biggest rort on the planet. Anyone that's had any kind of medical attention in the US knows that it's just phenomenally expensive for no real reason. I think it was Michael Moore. Do you remember Michael Moore, the documentary guy, rolling for Columbine, all that sort of stuff? Did a documentary on health and an asthma spray manufactured in the US by a US company was selling it around $80 for a US hospital, and you can get it for 62 cents in Havana in Cuba, exactly the same product. Crazy. Showing you the amount of fat that's in there. So, yes, there's a right for hospitals to negotiate, and it all sounds great. Whether that has an impact or not will be another matter. So, that midterm and general politics. New housing starts, another one. The housing industry in the US has been, surprisingly robust over the last probably 12, 18 months, but we're starting to see some cracks there. New housing starts are a little bit slower.
I think home sales are down and construction starts are down as well.
And I guess that had to happen from the fever pitch that was going on before. If you have effectively zero interest rates, people will buy property because why wouldn't you? It's a real asset in an inflationary environment, but that balloon is starting to let out a bit of air now. So that'll be something that has probably far-reaching consequences, given it's a backbone of most economies in terms of the construction sector. That said, on the other side of the coin, a slowing down of the construction sector will also help ease some of the pressure and inflation, which is, of course, a positive on the other side.
And you speak of before, AB, the fragility of markets, and we had Powell's speech last week. There's been a number of different examples of that through the year. Yeah. If you're a trader right now, where are you sort of looking to next to avoid that? Because that's pretty tough going.
Yes, it is. And I think, in essence, Mitch, what we're coming back to now is that notion that successful, and this might sort of be a bit of a head spin, but successful trading and investing, it's not about forecasting or predicting what the market is going to do. Now, a lot of people go, well, yes, it is. It's about buying low and selling high and trying to put your pieces on the chessboard in the right place at the right time. The challenge with forecasting, or let's call it what it is, guessing, because effectively you've got a 50-50 chance of being right or wrong, and you can try and make an educated guess based on all sorts of different things, but the reality is it's still a guess. Successful investing in my mind isn't about trying to guess or forecast where the market's going and what it's doing. It's more about being nimble and being able to respond to what's happening now. And the reason why happening now is so important, it's a fact. It's not a guess as to what might happen, it's a fact. So some of the things to come back to assist in that taking action, this is where charting is especially important. Having your trend lines in play and accurately in play, and your support and resistance levels are massively important. So if you've got something that's been in a medium and short-term bullish run, it's likely to continue to do that. But if you've got something that's all over the place and hasn't really formed a trend, it's going to be very, very hard, and it shows something that's quite fickle and likely to bounce around with the wrong kind of commentary. Whereas if you've got something that's been trending and it's absorbed some of the comments and commentary that's come out of markets and the market influences over the last 3 to 6 months, and then there's a stronger story behind it, and you can be more comfortable backing that kind of investment. So I wouldn't be trying to guess where it's going next. So you can forecast the market's going to be marginally higher by the end of the year, but we're probably going to have a pullback in September. That's a great forecast to have. Probably going to be right, but could easily just as well be wrong. And if you're on the wrong side of that, it makes it quite tricky. So doing your work, getting your charts up to date, having your levels drawn on there, having a very decisive action plan, I think, is critical. So if this happens, then I'm going to do this. If this happens, then I'm going to do that. It is crucial, and it stops you second guessing yourself in these fast moving markets. So, a good example of that would be, look, if you've got you're looking for an entry, and let's say, for argument's sake, it could be a short entry into the market. The news commentary coming out of Powell caused the market to sell off. It was a break of a short-term uptrend. It's consistent with where the medium trend is for markets. So if that happens and markets drop below this support level, I'm going to short the market either by buying a put, buying a short future, or should I say selling a future, or buying a short ETF, or whatever it may be that is your go-to strategy, buying a put option, or selling calls, whatever, buying spreads, whatever your go-to strategy might be under those circumstances, be ready to do it. So on that break of the trend and the confirmation is there, take the action, as opposed to, oh yeah, it looks like it's starting to trend down. Let's just wait for a week, see what happens. It's already done its thing. So by the time you're getting in, you're chasing the game. You're then vulnerable to FOMO. You got to get in before it's too late. And that's a bad entry, silly decision. So, doing the homework now and being ready. If this happens, then I'm going to do that. But if that happens, I'm going to do this. So having a bit of a dogleg game plan. So, if markets move higher, you've got an action plan. If markets move lower, you've got an action plan. If they stay flat, you've got an action plan. Lay out the work now so that when the confirmation presents itself, you're not there thinking, what should I do under these circumstances? You're actually in action mode and capitalizing on the opportunity that presents. And that's really hard. It's easy to talk about and it's easy to do because that's what we do for a living. But, for Joe Bag of Donuts, the average person that's out there managing a portfolio or some investments, it's actually very, very hard to do real time, because sifting out what's important and what's not, and what to do and what not to do under those circumstances requires a level of training, and it requires a level of objectivity, which is not being bounced around based on psychology and a fear factor of a recession or bad earnings or inflation getting out of control, but just seeing things for what they are. It takes a lot to build that muscle memory up. It's learnable. It's what we do. It's what we teach as a bread and butter business. And we've got thousands of clients out there doing it, but don't fall into the trap of, okay, here's all the green flags, here's all the red ones. Okay, there's more green than red, therefore the market's going to go up. It takes one headline to change that argument.
As it did Friday. Crazy. What about the impact of fundamental analysis, AB? Arguably one of the hardest pillars of analysis, albeit probably very relevant to this situation.
Look, it is. I spoke about looking at your charts to help with your timing, and in this kind of fickle market, that's your ultimate red and green flag to validate what you might be seeing on a fundamental perspective. And I think bringing those two things together in focus is critical. The fundamentals have to support your technical view, and the technical view has to support your fundamentals. And that's not about curve fitting and this is my view, let's try and force it to work. You've got to try and really be objective about that. And the big fundamentals are, what is the biggest threat to markets right now? And I think, with volatility at these lower levels, the volatility balloon has shrunk considerably over the last 2 months or 6 weeks particularly. Why has volatility dropped? Have we become accustomed to living in this fear of a recession, for example? And is that overdone? Is volatility now too cheap? Is now the time to buy it? Because, what are the risks that sit out there? I think, we still have a conflict in Europe. We're moving toward, the back end of the year, which for the Northern Hemisphere means we're moving back into winter. And there's a demand, and there will, even though energy prices have come off, there is going to be a demand for heating oil or natural gas to keep people warm and avoid literally freezing to death through the winter months. And we've got that conflict with Russia turning down, in fact, turning off one of its gas pipelines while it services a turbine. Very
Nord
convenient.
Stream 2, is that right?
Exactly right. So very convenient timing for that particular course of action, which is going to send a lot of people a little more nervous about what the future might look like there. And I do think we're in for, as we come out of if we have a soft landing, we go back into expansion mode, stronger demand for energy prices. So that energy risk and spike in energy prices and the effect that can have on an economy remains there. And I think volatility is possibly underpriced a little bit on the back of that, for example. So there's an example of some fundamentals coming together, a little bit messy in the way that we've laid it out, but volatility is cheap. Energy prices have also come off the boil and are likely to see a spike. Would be two things I think to look out for from a trader's perspective. That said, there's great value out there in markets right now, even though we've seen something of a rally in markets. And I think buying sustainable businesses that have good growth prospects at cheaper levels remains a good robust game to have. It's one of the better paying games in town. Boring is good sometimes.
As long as you get paid, you'd rather be rich and right at the same time.
Yeah, no, well, they're not always the same thing, but if you can be right and rich, you can be conceited from sitting on your throne, I suppose. But yeah, it's certainly interesting times. And I think more than anything, and I hate to be a scaremonger, and that's definitely not the tenor of this podcast, never has been, never will be. At the same time, I think it would be negligent of us not to point out to our followers, our listeners, people in our ecosystem, that there remains a level of risk on right now. It's not going to take a lot, as we saw from one comment on Friday, to send markets running for the hills, particularly after the speed of recovery that we've seen, and also going through some of the green and red flags that we've had here. China economic implosion or slowdown, and we've just seen bushfires there, for example, on the back of a drought that has got the potential to play hell with markets in terms of supply chains and things like that. We've got a drought in the US where you've got Lake Mead at 20% of its capacity, which means your farmers in the Southern California, Arizona area may not have water for irrigation, which causes a devastating impact on food supply. Same in Mexico too, for that matter, which gives you inflation on your food products and your basic goods. So there's prospects for energy inflation to come back and food price inflation to come back really, really quickly. So we might see a 50 basis point rate rise if that was a forecast, not that we're in that game, from the next FOMC meeting. There's nothing to say that's the last move, because if inflation comes back, they're going to get out with the size 12 cowboy boots and stamp that into the ground.
Interesting, AB. Thank you very much for that analysis. I think really good outlay there of the data and then how that affects markets. So any final words before we cap off today?
Risk management, absolutely key through these times. Cannot stress how important it is. There are, in these kind of markets that are not trending markets, there's a good chance that you're going to be wrong at some point. And it doesn't matter that you're wrong, it's how you handle being wrong. So what strategy do you have in play if your view or what you're doing isn't working? And I would say, the first cut is always the cheapest. It's always the easiest. In fact, we've got an interview coming up in a couple of weeks' time with my good buddy.
Oh, I can't wait for this.
And one of the most notorious traders in the 1990s, literally global stardom, all for the wrong reasons for this particular character. And as his advice comes through loud and clear in our interview, the first cut's always the cheapest. So risk management is crucial. If you're not sure who I'm talking about, that podcast will be coming out in a couple of weeks' time, and look out for that. It's an absolute ripping interview, that's for sure.
You've got me there, AB. Thank you very much.
The intrigue frame. So manage risk. Most important thing for our clients right now is to manage risk. If things go wrong, cut it quick, be decisive, and don't second guess yourself. This is not an environment to, give it a day before you know it, you're in all sorts of tricky conditions, which is not where you want to find yourself, especially when you've got Christmas presents to buy in a couple of months' time.
Can't wait for that. Ready to go. Awesome. Well, thank you very much for your time today. It'd be a great little insight there.
Absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you give us a review and a rating so we can get this message out further, have more people in front of this good quality information, and we'll look forward to hosting you next week.